Okay, so it's time to have a look at my Vanguard portfolio update for the month of July. Again, I can't believe how quick this month has already gone. Now, we didn't do one in June, but let's look back at those figures that I did in my last update in May. I have 2 accounts on the platform, and let's just remind ourselves here, the ISA value in May was £10,975, and the SIP value all the way back in May was £40,516. So let's log on and have a little look and see what the damage is, because of course the first start of this year has been pretty bad for the stock market. And if you've been paying attention to any of the rest of my videos, you'll know that this has been the worst start to the stock market since 1970, way before I was born. So let's have a look. Let's quickly jump into the ISA first. Of course, my tax protected account. Don't forget, everyone, you do have your stocks and shares ISA to make the most of £20,000 per year that you can actually put into these accounts. So definitely make the most of it. My portfolio is a really simple one, and we can see the value here is £11,129.16. So we are slightly improved from a couple of months ago. Nothing has changed in terms of the contributions I've made this month, and nothing has changed in terms of the way I have everything allocated. As you can see on screen, I have a very simple portfolio made up of 2 different ETFs, one of them being VUSA and the other being VFEM. So VFEM is those emerging markets, which I have allocated around the kind of 15% mark, and most of my wealth and most of the rest of my account is in VUSA. So that's an ETF, of course, that tracks the S&P 500, those 500 largest companies headquartered out of the United States. So if we go over to the investments tab and we have a look how we've actually performed month by month, Vanguard breaks everything down for you, so we can see that we're not really up by much, and not a huge amount has changed. Of course, I haven't had this ISA open for a huge amount of time, so I wouldn't expect anything miraculous. As you can see, most of the numbers here are red, which, to be honest, is not necessarily a bad thing. I can imagine though, if this is the first time you started investing, or if you've just invested only very recently, you're probably looking at these numbers thinking, I've made a terrible decision and I should stop investing right now. But from my personal opinion, of course, and being an investor who's been in the market for quite some time and in and out of it way too many times, I would like to admit, the key thing here, of course, is building your wealth during these years and making the most of these dips, which is why the number you see on paper, of course, is really irrelevant. I don't care if it's down 500, 1,000 or even £5,000 at this stage. It's all about wealth accumulation at the moment. So there you can see it. Finally, we've made a little bit of a return back in July. The only purchase I made was because VUSA pays some dividends. As you may know, the S&P 500, I think the dividend yield is around 2% or just under 2%. And of course, that does get paid to you inside your account, and you do have to choose how you want to reinvest that. So I think I made 1 purchase of VUSA. I'll pop that up on screen now for you so you can have a look. So that's a really nice, simple portfolio. Nothing too complicated about that one. This is all about long-term growth at the end of the day. Now let's head over to my SIP, which is my personal pension, which I've invested myself. And I've collected all of my different workplace pensions from over the years, and I've put them in one single place. Let's have a look at that one now. So you can see my pension value has actually increased since May, but it's actually down since I've moved everything over to Vanguard. But again, I don't see me crying. I'm not too concerned about it. We're at £40,976.05. Now, that is a nice chunk of change, and you might think, wow, I can go and live a lavish lifestyle. But remember that this is ultimately for my pension. But don't forget, I can't actually touch this or access this until I'm 58. So I'm going to be much older and grayer before I get my hands on this. But the good thing is, then that's 20 plus years of compounding to enable me to get there. Again, it's a very similar setup. The only difference here is that rather than just having VUSA and an emerging markets ETF, I've actually got an emerging markets index fund. Now, I can't remember if that was by accident or if that was on purpose. I think it was because in my old Hargreaves Lansdowne account, I actually had this Vanguard fund, so I just moved it over directly. So the difference, of course, between an index fund and an ETF really is just the way it's sold. Remember, your ETFs are sold on the stock market, and typically, most likely, they have slightly lower fees as well. The only downside about some mutual funds, as powerful as they can be to grow wealth, is that they can charge a few additional fees and do have a couple of hidden fees in the background worth being aware of. But overall, touch wood, Vanguard's a very cost-effective platform. Now, the good thing about managing your pension, and a bad thing about managing your pension, of course, is you have to decide what you want to have it invested in. I'll definitely put a wager out there that the majority of you probably don't really know what your pension's invested in. It's not necessarily a bad thing, because once you take control of that money, you really need to kind of know what you're doing. But in my opinion, if you do kind of know what you're doing and you can invest in low-cost broad index funds and you're not going to go too crazy with it, I think you'll put yourself in a pretty good position. Because if you look into some of these pension accounts, whether it's with the big firms like Scottish Widows or Legal & General, in my opinion, at least for me, they put you in quite a quite a low risk blend of equities and bonds, and their fees, of course, are a lot higher than Vanguard. And over those years, they can really add up. So worth looking into if you want to. There's lots of services online. You've got the money advice service, and of course, you've got lots of pension finders too. So if you've had 5 or 6 different jobs, there will be pensions out there, no doubt, which you're welcome to move into. Now, quickly having a look into the performance month by month. Again, clearly in hindsight, a terrible time to move my pension over, but I know that actually a big chunk of this pension itself is actually made up of gains which I've received previously. So remember, I just migrated it over, so it's not like my all-time returns are a negative percentage. But of course, it just shows how bad the start of the year we've had here. We've got May and June, both nearly £2,000 there, losing out of the account. But again, as I've said before, as a long-term investor, this is not something I'm concerned about at all. And ultimately, I think I've put my money in a safe bet with the S&P 500. So at the end of the day, when you think, where's this going to be in 20 plus, or maybe even further, many, many years, I'd be confident to say that we should be going in one direction. It will no doubt be a bumpy ride, and this is certainly going to be a terrible time to start if you're just starting to think about investing, and you're probably thinking you've missed out on all those gains of 2020 and 2021. But honestly, don't worry, you've got plenty of time ahead of you. Now, as a bit of bonus on this portfolio update, I thought I'd actually go through some frequent questions that I tend to get and I see in the comment section when I do these portfolio updates. So I thought I would address them now so any of the newbies watching can get some of my answers and my own opinions. Up first, I always get asked the question, why did I pick VUSA that pays a dividend and not use another fund? Because the annoying thing about, of course, that being paid a dividend means I have to manually reinvest it. There's no way of automatically doing it. And Vanguard does have a fund that actually is exactly the same as this, but reinvests the dividends automatically. And it has a ticker symbol of VUAG. And the answer is basically because they don't allow you to have access to VUAG on their direct platform. And this goes with a number of different funds. So unfortunately, they don't allow you to have access to that. So all you have really as an ETF is VUSA. You can get VUAG on lots of other platforms. So whether you used Free Trade, Hargreaves Lansdown, Interactive Brokers, as an ETF, you can easily get hold of that, and that will reinvest your dividends. In my personal view, that would probably be a better place to be rather than having to manually go into this account and monitor those dividends. But it's okay, it's just something I put up with. And question number 2, this is something that I do consider myself a lot, and lots of people do kind of contribute and say, am I worried about my diversification here? Have I got enough in the portfolio? So there's 2 ways to look at this. I'm always open to reconsidering my position, thinking, am I diversified enough around the world? Lots of people kind of a fair opinion to say that the US stock market is overvalued. And of course, that's people's different opinions. You can say that at one point in time. Ultimately, the market moves in cycles, right? You have international markets and you have the US markets, which tend to underperform or outperform each other over different periods of time. But I think the main thing for me and the main thing that keeps me going is that in the very, very long term, even if VUSA, even the stock market in the US outperforms or underperforms over even a 10-year stretch, I'll keep accumulating, and in the long term, I'm not necessarily too bothered. And also a topic I cover on lots of my other videos is that although these companies are headquartered in the US, they do get a big chunk of their income from international markets. So it's not like that by investing in the US, you only have the US market. That's quite wrong. In fact, you've actually got a much bigger global play. I mean, just think about all those big companies, Apple, Microsoft, Tesla, Amazon. They get a huge amount of their revenue and profits from around the world. So never say never to changing the portfolio to investing in the FTSE 250, some smaller companies and other indexes. I'm completely open to that. I've got many years to be able to do that. But for now, I'm very happy with that. But you should always consider your own risk tolerance and how diverse you want to actually be. Number 3, I've kind of juxtaposed this question together, but if I could pick just one fund forever, what would it be? Now, you might think I'm slightly biased here in saying, well, I'll just pick VUSA. Personally, though, I think if you were a beginner and you just wanted to own the whole market and not worry about another thing for the rest of your investing career, something like VWRL. This is a global ETF that has thousands of companies inside of it and will ultimately give you exposure to the whole global market. And in my opinion, if I was potentially starting again and I just wanted to have a set and forget, not worry about where I'm allocating funds, VWRL personally could be a very good bet. But again, something to consider and look into yourself. Next up, I get this a lot and I do see you guys questioning this. Is now a good time to invest? And I think every investor getting started asks the exact same question. And every investor thinks at the moment you invest, of course, there's going to be a stock market crash. The bottom line here is that all of the data out there shows that lump sum investing and investing right away, right now, wins most of the time. And I think the data the last time I looked at it is around 65% of the time you win by putting your money in, called lump sum. Now, if you do dollar cost average, so you invest monthly, technically as you get paid, that is lump sum investing. You're not trying to time the market, you just get your money in there. Personally, in my opinion, there's no point trying to time the market. You may as well just get your money in there. But the main thing that I would consider as my investing career progresses, it's really up to you. Can you sleep at night if you put a big lump sum in, you know, 2, 3, 4, 5,000 pounds or even more? Would you be annoyed to see that drop 20%? Or would you rather just say, drip that in over some weeks or months? Completely up to you. And I think at the end of the day, regardless of what the stats say, even if 65 or 70% of the time lump sum works better off, it's all up to you at the end of the day. So consider that option. Look at the stats. The stats say one thing, but really you got to go with your own gut feel and how that's actually going to let you sleep at night. And I think that's probably the best test. And finally, last question here says, why have you not already hit the like button and made sure you were subscribed? Well, honestly, I've got no idea for that one. But if you could hit the like button for me and subscribe if you're new, why not get a bit of action from a UK-based finance creator and help the video get out to more people like you. Anyway, plans moving forward with this portfolio, of course, just keep contributing, keep going in for the long term, and we'll get through all of these bad times and enjoy the good times, which may come in 5, 10, or 20 years' time. Anyway, if you want to keep track of all my other portfolios, then please feel free to go on my channel. I do leave a link in the description of most of my videos with my entire playlist of all my portfolios. We have Hargreaves Lansdown, we have Free Trade, we have Vanguard, of course, we're looking at now, and I do have a portfolio on Lightyear, which I keep saying I need to get around to doing a further update on, where I've been buying up some tech stocks. So I've been a bit naughty recently. I've been saying I don't want to buy some index funds, I wanted to buy some cheap stocks, so have a look out for that one when I get round to it. Either way, thanks so much for watching, and as always, happy investing.